Hello, everybody. Thank you for joining Kaiko's November analyst call. I think we are about ready to get started. So thank you all for joining. This is for once over the past year, a very positive month in crypto markets. We are going to talk about the latest crypto rally. We call it Uptober because historically October has been a bullish month in cryptocurrency markets, and we're sort of seeing a continuation of this bull rally over the past few weeks. Bitcoin is currently trading above $36,000, and this is an increase of more than 10K just over the past 30 days. So we're seeing really a sharp turnaround. And at Kaiko, we have noticed for the first time in 6 months, a real shift in crypto market structure. So today we're going to look at prices, we're going to look at altcoins and liquidity to try and understand what's actually happening in crypto. But before we get started, in case you are new here, who are we? Kaiko is a crypto data provider. We were founded in 2014. Today, we offer 4 services. The first is market data. This is tick level and aggregated data from more than 100 centralized and decentralized exchanges. We also offer our compliant rates and indices for financial products. We have quantitative analytics, and then finally, research. This is who you are seeing today. I lead the Kaiko Research team, and I am joined by Riyadh and Desi. So just some minor Kaiko updates. We have 2 new data products. We have wallet data, which is a new data type for powerful blockchain transaction analysis. It's really designed for auditors and regulators for gaining deeper understanding of crypto transactions. The second is our blue chip indices. This is really designed for financial product issuers and other index providers. These are benchmarking the top 5, 10, and 15 most liquid digital assets. As for Kaiko Research, today we have 5 research offerings. We have 2 research newsletters, a quarterly report, a chart book, and then the analyst call, which you are on today. And most important, all of Kaiko's research is powered by Kaiko's data. If you are interested in Kaiko data, you can learn more at our website. We offer dozens of individual data types covering both centralized and decentralized markets. And if you don't know if our data is right for you, we will be happy to pair you with one of our product specialists. So let's dive into the market analysis. So our last webinar, this was 1 month ago, we focused on hype around a potential Bitcoin ETF. And that hype is ongoing. It's been a month now. We still have not gotten a spot ETF approval, but you would never guess that from markets. Markets continue to rally. So if we just look at Bitcoin's price over the past month, there is a specific date that stands out. That is October 16th. On October 16th, the news website Cointelegraph falsely published a rumor that didn't end up being true, that there was a Bitcoin spot ETF that had been approved. This instantly caused Bitcoin's price to rise. And you would think that once this rumor was disproved, that this would cause markets to pull back. But the opposite happened. In fact, this one false rumor sort of triggered the bull run that we are seeing today. And that's because there have been sort of a sequence of even more spot ETF applications. And there's a lot of hype that's just building that we're probably going to get an approval very soon. And you can see here, this chart goes back since January of 2022. And we can see that Bitcoin today is at 18-month highs, its highest level since May of 2022. This is significant, this date in particular, because this is when all of the collapses started happening. May 2022, this was the Terra collapse, and then we saw all the way up to the FTX collapse. So it's quite significant that we have regained these price levels that we lost over the past year and a half. So we now have this amazing chart that Desi made, essentially breaking down Uptober, essentially changes in price on the right side since October 1st relative to the distance of these prices from all-time high. You'll notice sort of a sea of red. You can see that most crypto assets, although they have had these amazing gains since October 1st, they are still well below all-time highs. You'll also notice something interesting, that while Bitcoin certainly did kick off the rally, other crypto assets have come to lead in the weeks since, specifically Solana. Sol is up more than 150% since October 1st. However, it is still 77% below all-time highs. So we can see here that some of these smaller crypto assets have really had the biggest gains, which is expected. In a bull rally, it's the smaller crypto assets that tend to be more volatile and see these large price surges. We can see here that Bitcoin is up around 35%. So although it has gained the most attention, it is by far not the biggest gainer. So that brings us to the ETH to BTC ratio. Actually, over the past week, while we're going to talk a lot about Bitcoin, it's actually ETH that has stolen a bit of the limelight over the past 7 days. This is because BlackRock just filed for an ETH spot ETF. So we can see that ETH is joining the rally. Over the past year, ETH has very much underperformed Bitcoin, especially since the merge. Many thought that last September's merge would be sort of the big catalyst for a big ETH bull run. That unfortunately did not happen, and we saw ETH underperforming Bitcoin for much of the past year. However, that changed slightly last week, and we're finally seeing ETH start to climb relative to Bitcoin. And Sol is a whole other conversation. Solana suffered heavily during the FTX collapse. It was known as one of Sam Bankman-Fried's tokens simply because FTX had invested a lot into the Solana ecosystem. The ecosystem was very much devastated by this collapse, but we can see here that Sol is now outperforming ETH over the past month as it gains more than 150%. And we will talk a bit more about Sol liquidity later on in this presentation. So let's now take a step back. Let's start looking at measures like volatility, especially relative to traditional assets. Here we are looking at the 30-day historical volatility for Bitcoin in orange, Ethereum in blue, and then the S&P 500 in gray. And we can see this red annotation showing that towards the end of the summer, they were almost identical, the historical volatility, which is almost unprecedented in crypto markets. Crypto markets have always been way more volatile than equity markets, but over the summer, markets were sleeping. There was barely anything happening on the price side, and we saw historical volatility dip to multi-year lows and almost touch that of the S&P 500. But we've seen a reversal, of course, as markets start to rally. Let's now take a closer look at the correlation with risk assets. Everyone loves talking about Bitcoin's correlation with risk assets. I have seen it rise and fall over the past 5 years. I have worked in the crypto industry, and so I think it's quite difficult to actually draw deep insights from this correlation. But nonetheless, it does give some information on how investors are treating cryptocurrencies. I think over the past month, if we zoom in there, we'll notice that the correlation has fallen, which is significant. This is because crypto markets have rallied while equity markets overall over the past month have not had the best of times. Of course, over the past week, that has all changed, but this data is a lagging indicator. So we can see, and it's actually 60-day correlation. So we can see here that crypto markets were strongly diverging from equity markets over the past month. This is sort of a longer term downtrend since the FTX collapse. We have seen this decorrelation. Now moving on to derivatives markets. This is the last section here before I toss the mic. Derivatives markets historically have had a big role in price movements. However, there has been a big drop off in leverage ever since the FTX collapse. Open interest has stayed pretty flat. Except for what happened on August 17th. We had a big sell-off in crypto markets, which caused a lot of liquidations. And we can see here a big dip in open interest for Ethereum perpetual futures contracts. We saw this big dip, and over the past 2 months, this has almost fully rebuilt. So we have open interest that has steadily increased over time. And for ETH in particular, we've noticed that funding rates have spiked, which is a bullish sign. This happened last week after the BlackRock ETF news. And it's interesting to compare ETH to Bitcoin because when we see here, we do not see the same trend. We see the similar sell-off on August 17th, where we saw a big reduction in the quantity of contracts. However, we have not seen an increase in open interest. In fact, we've actually seen a decrease. This is because there were a lot of shorts that got liquidated. Bitcoin sort of Bitcoin's rally has caught a lot of people off guard that weren't expecting this and has triggered quite a few short liquidations. Some measures show more than 1.1 billion in liquidations over the past 30 days. And we can see that Bitcoin's open interest has actually fallen to multi-month lows. So now I'm going to pass the mic over to Riyadh, who is going to talk about some of his research that he just did last week.
Yeah, thanks, Clara. As you mentioned, the ETF is big news. So I wanted to take a really granular look first at, why they were rejected in the past, and then what the data can tell us about whether this time will be different. So in the past, they've been rejected on market manipulation concerns. Essentially, the SEC said, you need to have a surveillance sharing agreement with a significant market. Their definition of significant market is if you wanted to manipulate the ETF, you would also have to manipulate on this significant market. So I wanted to take a look and see, what qualifies as a significant market, given that, BlackRock in its first filing didn't name a specific exchange that it was going to have this agreement with. And then it was updated a few weeks later to include an agreement with Coinbase. So with that background, let's take a look. So I think first it's important to recognize that not all minutes are equal. The vast majority of minutes, not that much happens. So here shows what I've called the intra-minute variation. So essentially the difference between the high and low in any particular minute. And this was from about a 2-week period at the end of October. And you can see, again, most minutes, not that much happens. Out of 30,000 minutes charted here, only 15 had a price move of more than 1%. So I really wanted to hone in on these highly volatile minutes to see which exchanges had the most effect over price. So if we go to the next slide, you can get a good picture of that here. So starting on the right, you can see 10 average minutes, with average price movement. You can see Binance regularly has 50% of market share. Coinbase fluctuates between 20 and 1% basically. Kraken, not too much. And then you also see MEXC is pretty prominent here. That's that really bright orange. So MEXC has 0 fees. So that sort of explains that. And Binance's BTC FDUSD pair is also really prominent during the less volatile minutes. But then if you move to the left, you can look at the 10 most volatile. And I think it's pretty interesting how standard it is across these minutes. Coinbase regularly has 10 to 15% market share. Binance slightly lower than during average minutes at about 35%. And that's largely because their FDUSD share drops to near 0. OKEX performs pretty well. Kraken performs better than normal. I think LMAX is the biggest outperformer. Bitstamp also does pretty well. So there's a sort of a trend here of the more regulated exchanges actually having a greater influence during the most volatile periods, which I think is a positive. If we go to the next slide, we can compare this to 2021. This is around when the ETFs were rejected last time. And you can see it's a very mixed picture. Binance's market share was much less. Exchanges like Gemini performed pretty well. HTX, Huobi also performed well. FTX is in there. So it was really just a mixed picture. But I think the main takeaway that I sort of got from this is that Coinbase's share from 2021 to 2023 during the most volatile minutes has expanded and is really steady. I think that's a positive sign. It essentially, it's hard to imagine a situation in which an entity would be able to manipulate the ETF's price without also trading on Coinbase, which is sort of the fundamental question here. And then just to give some perspective on the last slide, if we look at the spot market compared to the two largest gold ETFs, last month, Bitcoin did about 200 billion in volume. Those two ETFs combined did about 50 billion. So I think it's safe to say that even if a spot Bitcoin ETF is approved, even if many are approved, that market, that volume will still very likely pale in comparison to the spot market, which makes the manipulation claims a bit more dubious. So I think all in all, this paints a pretty good picture, pretty positive on the ETF's possibilities, at least related to that argument. And with that, I'll pass it over to Desi.
Thanks, Riyad. So I'm going to talk about order book liquidity and trade volumes. And the first chart I wanted to show is what we call the Alameda gap. This is the gap in crypto liquidity, which was left by the collapse of FTX. What we essentially see is that market depth has declined by 60% after FTX collapsed and has not recovered. The Alameda gap has been very sticky over the past year. This is partly related to the low volatility, low volume regime we have been stuck in. As Clara mentioned, volumes have been very, very low this summer, volatility as well. And this essentially kept market makers out of the market because they are earning their revenues from spreads, right? Next, let's zoom a bit on the Bitcoin rally. So Bitcoin has been rallying pretty significantly in October. It's up more than 35%. But market depth, and this chart here shows the buy and sell 1% market depth for Bitcoin. Market depth has been super flat. It has not increased at all. It has actually declined a bit, which essentially shows the same thing, that market makers have not changed their behavior and have not increased their exposure, even though Bitcoin has rallied. So the next chart looks at trade volumes. What's happening there? Trade volumes, on the other hand, have been rising, and this is a very positive news. They have been very, very low over the summer. We had trade volumes fall to their lowest level since November of 2020. So this changed in October. The overall trade volumes for Bitcoin, Ethereum, and altcoins has actually increased to its highest level since March. And as of early November, which is for me the main takeaway from this chart, it's actually altcoins that have been driving the rally. It's partly related to the macro environment. We know that treasury yields are going down, and we just had a softer than expected inflation reports, which basically reinforced the narrative that the Fed is done hiking, and markets are now expecting rate cuts in May 2024. The next chart, however, shows that crypto-specific catalysts have also been driving altcoins, and this is Ethereum trade volumes. Clara mentioned the BlackRock filing last week. Ethereum has been underperforming since the merge, but the BlackRock spot ETF filling has actually sent volumes to their highest level since the collapse of FTX. This is super evident when we look at the share of altcoins relative to Bitcoin. If you go to the next chart, we see that Bitcoin has been dominating the market this year with a market share of trade volumes of over 50%. But in the beginning of November, the share of altcoins actually increased to 60%, which is highest level since April of 2022. So basically, altcoins are gaining traction. This typically happens during risk-on markets, and it's a very positive news. So looking at the altcoins driving the rally, and this is the next chart, which shows the cumulative altcoin trade volumes on US available exchanges in 2023. what we essentially see is that Solana has been the market leader with trade volumes of over 30 billions, outperforming the other altcoins by a large margin. It actually comes in a time where FTX is starting to sell Solana, so it's even more interesting. However, liquidity has not been following, and this is the next chart, which shows Solana order book liquidity. We actually covered this in our data debrief yesterday. Solana market depth in native units has actually been declining, and it's currently at its lowest level since the collapse of FTX. It means that market makers are cautious and not taking new exposure. In US dollars, it has increased because of the price impact. Solana is up more than 150% since the start of October. So just to finish with the last chart and to give you some perspective on the Solana rally, the next chart shows the Solana ecosystem tokens. All of these tokens have been impacted by Alameda, and they have not recovered. Most of them are down between 50 and 90%. Market depth has completely vanished for these tokens. MAPS and Oxy are actually not traded on centralized exchanges anymore. So the recovery has been really focused on Solana. So with this, I'm going to give the floor to questions.
Thank you, Desi. So I guess that concludes our presentation today. So feel free to ask any questions in the chat, and we can start with one from August. I've heard people talking about Solana being manipulated by market makers and its historic investors who would drive the token price up before liquidating the assets to reimburse FTX. So I guess the question is probably linked to why Solana is rallying, if this has anything to do with the FTX liquidations. In my opinion, they seem to be it's quite a coincidence that FTX just announced that they would be liquidating Solana. They just moved a lot of SOL to centralized exchanges right as SOL's price skyrockets 150% with no clear catalyst. So it does seem, I would say, like a suspicious increase in prices no matter what, but ultimately very hard to figure out why. Maybe Riyad or Desi, you guys have thoughts?
Yeah, I mean, we haven't seen any obvious, signs of manipulation. So I'd have to reserve judgment on that. I do think it has a pretty nice narrative, honestly, of that it came around during the SBF trial of, sort of a beleaguered L1 that is much cheaper than Ethereum to use when the network gets busy. People thought it was dead after FTX's collapse. So there are some sort of rational narratives that make sense to me, but yeah, I don't have too much of an opinion on any sort of manipulation.
Yeah, it's very hard to tell with our data, but I mean, Solana really started low. This is one of the charts Clara showed with the distance from all-time high. It's still 77% below its all-time high. So we have to take this into account as well.
That it could just be regaining what it had already lost.
Yeah, a bit of a piece of it.
Mm-hmm.
Okay. Next question from Toshi. Spot has been leading the markets. Open interest is at a really low point. Stablecoin inflow went up a bit yesterday. Let me see what the question. Do you see any flow that would keep the price up at this point? Yeah, so this is just more predicting if the rally is going to last. That's the ultimate question. No, that's not the question. Okay, new capital inflow. Are we seeing this? Okay, I guess in which case, if we're looking at liquidity, like market depth, we're actually not really seeing that. We're not seeing an increase in market depth on order books. We are seeing, though, an increase in trade volume. So it seems like, trading activity is picking up, but in terms of market makers actually supplying liquidity to these books, not so much.
Yeah, agreed.
Okay, we have another question. Have we checked if the price run for Bitcoin is driven by spot or futures following the false Cointelegraph tweet? So I would agree with Toshi in that because open interest is pretty low, flat, that a lot of this is spot driven right now. A lot of derivatives activity has stayed quite stable over much of the past year, not really growing at all. So we can't really say it's derivatives led.
Yeah, agreed. And on the institutional players, it's hard to tell. They do a good job of disguising orders, so it's never too obvious when they're getting involved. But I think probably likely.
Yeah, I would say institutional activity is almost all on the ETF front right now. It's so hard to say. I would say Coinbase is the only exchange where we actually know which institutions are using because they're a public company. So in their filings, they differentiate trade volume institutional versus retail. They only do this because they have to, because it's part of their business. No other crypto exchange actually publishes any information on which proportion of their volume is institutional or retail.
Mhm.
Okay, question on Binance. Do you see Binance market share on derivatives falling next year? And if so, by how much? Desi, do you want to take this question?
It's hard to tell. It has fallen this year, for sure, especially for Ethereum. But I mean, if I have to say how much it will fall, it definitely faces more competition and they have some regulatory issues. So I guess, yeah. But it's hard to really have a figure.
Yeah, it seems like each bull run, there's a new exchange that sort of comes out as a market share stealer. And it seems like there are a couple that have positioned themselves pretty well going forward. Like Bybit comes to mind, has been pretty aggressive on the derivatives front. OKEx as well. So remains to be seen, but and they'll have more competition, as from Coinbase and from U.S. Exchanges too.
Okay, any more questions? I see one person typing. Can we get the slides? You can email research@kaiko.com and we will send you the slides, definitely. And we will also upload this to our website, research.kaiko.com, right after. Okay, from Jack. Hello, Jack. Any hot takes on why Bitcoin might be lagging stocks after this CPI print today? Desi, this is your area, CPI analysis. So I'll let you answer this.
Yeah, well, it's hard to say why it is lagging stocks right now, but yeah, CPI came really softer than expected, and stocks are rallying right now. So I guess, I mean, it should be supportive for risk assets. I guess we should also look at altcoins, what's happening there, because altcoins have been rallying as well. So, yeah.
Yeah, I would say also that movements around big data releases, it used to be a lot more volatile in crypto markets, but over the past year, this volatility in the hours before and after has fallen.
Yes, that's super true, yeah. Because CPI has become more predictable, I guess, as well.
Government shutdown, bearish for BTC. I don't know.
Depends if it means approval of ETF, no?
Oh, yeah.
I think non-issue, really.
I'll also send a link right now to our December analyst call, which you can already register for while we wait for some of the last questions to roll in. How do you rate the risk of a rapid wind down of Binance? Would this have the same impact as FTX? Oof, that's a tough one. Um, I would argue it would have a bigger impact because Binance is a much larger exchange than FTX. FTX is quite small. It only had, I think, it had under 10% of global volumes, whereas Binance right now has more than 50%.
Yeah, I think there's no doubt it would be much more significant than FTX.
Yeah. I mean, FTX was significant in that it sort of dragged a bunch of market makers down too, and lenders, it had this ripple effect throughout the industry. I would hope if something happened like this again, that there's a lot better risk measures in place among market makers. They're not like storing all of their money on one exchange anymore. They're not taking out huge loans that, are at risk. So we could have seen like, flushing out of all of these risky practices with FTX. Whereas even though Binance is much bigger, however, it still would be quite bad.
I would add that Binance market share is really a lot bigger than FTX. It's not comparable at all.
Yeah. Aside from Binance blowing up, any low probability events you foresee which would cause a major shakeout in crypto? Honestly, crypto adapts. I think that's what we've seen over the past year. No matter how big the event, crypto has a way of adapting and surviving. Maybe you guys have any comments?
Yeah, maybe I'm scarred from FTX, but I feel like this is all I see at this point. I've written about like the staked ETH liquidity issues. I think that as like degen activity picks up and there's a lot more leverage in DeFi, that becomes a bigger issue. You can find that on our website if you just search Steth. And then I've written about some other exchanges that are, I think there's some questionable things happening around the market. So we'll see. But I always think that there's a possibility for those kinds of events.
Sell the news event. I'm convinced. I feel like markets are pricing in a Bitcoin ETF approval right now. And so we very well could see that if it does get approved, there's like not really much of an impact because it's already happening right now.
Yeah, I think the one thing that changes the possibility of the sell the news is that it could actually have like a concrete effect on the way Bitcoin is traded and like the demand for it that's able to access it. So yeah, I think in maybe like a short term sell the news, yeah, but it's hard to see that, if it does manage good volumes, that it would have a significant pullback, just in my opinion.
Ooh, I'll let Riyadh get the DEX question.
Views of centralized exchanges will continue to dominate in liquidity. What would cause liquidity to flow to DEXs? I guess it sort of depends, how you. I guess it depends how you sort of classify like dominate liquidity. I mean, I think the main problem in DeFi that I can see is that liquidity has gotten fractured between chains and L2s and things like that. It seems like generally speaking, there's decent liquidity for the bigger tokens. I think liquidity would flow to DEXs, if it's profitable for people to LP there, which, it's obviously a hotly debated topic, but it tends to really be profitable for the most sophisticated actors. So, if we get more market makers who are willing to take the plunge into DeFi, then that would certainly boost liquidity. And then the correlation of 1% market depth to prices. If we're doing it in USD terms, they're pretty correlated. I don't think we've ever done the exact analysis of that, but they tend to move together. The next question was, why isn't the Alameda Gap drawing in new market makers? Is the issue that institutions don't want to hold significant capital on exchange post FTX? I think that's an issue. Also, the issue was just volumes were really low for the past year, and then it's not profitable if there's not a lot of volume. So, if we have some sustained volumes for a while, I would expect to see that liquidity would improve.
And it's also partly structural because a lot of market makers left the market or went out of business. But yeah, volumes and structural reasons, and probably, actually, that's a very good question, probably also risk aversion as well.
Is FTX to be resurrected, and if so, when? I mean, apparently they have a lot of assets. I doubt that FTX will be resurrected in its old form, but we noticed that FTX's old token, for some reason is rallying, even though there's like no guarantee it will ever be useful ever again. But there was like more than $400 million in daily volume last week. So it's clear that people are placing their bets. All right, any more questions? I see a couple more typers. I also think that liquidity has been down just because volume has been down. It's sort of not like, for a market maker, high volumes are what draws them in. That's how they earn their money. And if there's not much, then they're probably not gonna invest too much in crypto markets. So it's sort of a correlation between trade volume and liquidity. Okay, I think that is it. Any last questions? Thank you all for joining and for all of your questions. And we'll be back in 1 month for our last analyst call of the year.
Thank
Thank
you
you
all.
guys.